45 years. And the way that it works is the beginning of the cup would have been 1980 at $50. And then it goes down to the bottom, the shape of like a bowl or a cup, to $4 or thereabouts in the early 90s, and starts to come back up to 2011, almost to the top of the cup, doesn't preach it, comes down in consolidation for the handle. And here we are at basically $44, very close to moving back up. Now, the way that that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46. You would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect.
Silver's story today is not just about price. It's about history, technicals, and a structural shift in global finance. When you examine the long-term chart of silver, a 45-year cup and handle formation has taken shape, starting at the $50 peak in 1980, dipping to the $4 lows of the early 1990s, and steadily climbing back toward the rim. Technically, breaking through the $50 level would imply no resistance above, setting the next target near $100. Layer onto that the U.S. government's decision to reclassify silver as a critical mineral, and you see how the groundwork is being laid for a generational move. Adding India, Russia, China, and Saudi Arabia to the mix, the significance of this moment becomes undeniable. AndySchectman, a precious metals analyst and CEO of Miles Franklin, has long argued that silver is the most undervalued asset in the world. He points out how institutional traders in the U.S. are finally paying attention, while the public has yet to join the rally. This divergence is what creates asymmetric opportunity, low downside risk with enormous upside. Schectman notes that premiums, supply shortages, and soaring demand from both governments and private institutions suggest that the rules of the game are changing. If gold has already been rewoven into the monetary system, silver may be the next domino to fall. And with deficits ballooning, trust in fiat weakening, and metals pouring into COMEX, it may only be a matter of time before silver's role is fully repriced. Now, we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The amount of silver that's coming into the COMEX is off the charts. From a technical formation, you have a 45-year cup and handle that might be as powerful of a formation as you will ever find in technical analysis, especially one that is mature as silver. 45 years, and the way that it works is the beginning of the cup would have been 1980 at $50, and then it goes down to the bottom, the shape of like a bowl or a cup, to $4 or thereabouts in the early 90s, and starts to come back up to 2011, almost to the top of the cup, doesn't preach it, comes down in consolidation for the handle, and here we are at basically $44, very close to moving back up. Now, the way that that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46. You would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect at some point. And then when you realize that the government reclassified silver now as a critical element, a critical mineral, they've put a floor under the price of silver. And so I think, all of the talk over the last 6-7 months, and I said no from the get-go, this is not about tariffs, never was. It was a ruse to bring it all back. This is reshoring. This is understanding that the biggest money in the world understands the significance of things like silver. The biggest traders here in the United States, the institutional traders, when they start to pay attention, when they start to accumulate, we should all pay attention. We've been talking about this on a central bank level for a few years now. about the deliveries into COMEX for a few years now, about the accumulation by India, by Russia, by Saudi Arabia, by China. China flying around the world and buying doré when they're the second largest producer in the world, sending it back to China for refining. Why would the second largest producer of silver in the world find it necessary to fly to Latin America to buy concentrate and doré directly from a miner, pay double what the West will, ship it back for refining if it were just this, this rock that hasn't done anything forever? And I don't know, silver right now feels to me like gold did about a year ago when it was right in the $2,100-$2,200 range, and it kept trying to break out and would, consolidate and try to break out, come down, consolidate, in a long period of consolidation, and then broke through, and it hasn't looked back. I would say that's about where silver is right now. I look at it as the most undervalued asset in the world, and now evidently the United States finds it significant enough to call it critical. I think there are very few opportunities asymmetrically where you have such low downside and such high upside being asymmetrical. For an asset like this, it's once a generation. So I think the drivers are big money waking up. Now, you could argue that the public is not even part of this rally yet. What happens when they collectively wake up? This is being driven by people at the highest of levels before the public catches on, which is another contrarian indicator. So, yeah, I think what's driving gold and silver is that silver is finally catching up. Gold is being rewoven into the monetary fabric of the globe. And thankfully, someone in this administration, I think, grabbed President Trump and said, if we don't do this, we will forever regret it. This is our last opportunity to bring some of this home because the world is moving away from treasuries and dollars and paper promises. And then you add on to it sanctions and tariffs. After 4 years of nightmarish domestic and foreign policy, prior to this administration, you could argue a system that is fully based on trust has squandered the majority of it. And then, look, I would vote for President Trump again, but I don't agree with the way he is antagonizing even his allies, like India, as an example, throwing on 50% tariffs, and many of the other countries in the European Union and Canada. Maybe there's something bigger at play, which we've talked about a lot, but I think it's just beginning, quite frankly. Look, you have a comment coming out of Goldman Sachs a couple weeks ago that if the market even thinks that the Fed has lost independence, well, okay, the firing of Lisa Cook, who's going to go in there? It'll be a Trump bobo. You look at Stephen Murin replacing the last Fed official who left, who is the author of the Mar-a-Lago Accord. The Fed has lost independence. And mind you, this is nothing new. You go back through history, you'll see this happening with multiple presidents, but it's like they give you crumbs and the crumbs, well, we told you that this could happen. And now you have, banks talking as high as $6,600, 4,000 being base case for most of these banks. Look, you put silver at 5,000, like Goldman says, and divide it by 70, which would be, way higher than its average for the past 100 years, and still 10 times higher than it's coming out of the ground at. You're talking $75 silver or thereabouts. So, to me, this is just beginning, Elijah. Honestly, I do believe that, and I think this is the time that most of us have been talking about, as typically following suit way early. But I'd rather be months and even years early than 60 seconds late when the switch flips on this. You have, as we've talked about at length, 11 states already that recognize precious metals, many of which is specifically gold and silver eagles, as legal tender, and the U.S. Mint can't keep up. So the primary distributors who buy all of the large shipments from the mints, when the mints run out of product, the primary distributors now become the de facto market makers, and it's a function of supply and or demand. Spreads are very high right now because the price is getting higher. I remember, just a few years ago, like even with $1,500 gold, you're talking $30,000 for a tube of Silver Eagles. Now they're almost $80,000. And so cost of inventory is getting higher. Our premiums are going higher. And there's volatility that we expect to see based upon what we have seen for a very long time. But maybe the rules are being rewritten. Maybe things are changing. Maybe the government, for once, is going to let the price go higher instead of stepping on it through levered futures contracts. Maybe this has a lot to do with all the metal coming back, the reclassification of silver as strategic or critical, all of the talk of gold being woven into the back end of the Treasury market. He who has the gold makes the rules, says Trump. There are a lot of reasons to think that maybe this time is different. Now, usually when you hear that, you should run. This time is different. But I will say it does feel different. Ultimately, we'll have to see how it plays out, but I don't ever remember in all of my years doing this, Elijah, which is almost 36, seeing a market with this continual strength, and every time it's hit, it just comes right back. That is a characteristic that is certainly new, and feels like, they're just going to let it go much higher, in particular with gold, making the revaluation at some point much easier, and increasing the value of the holdings that they have. And if they really are going to revalue it, like a lot of people talk about, myself included, James Rickards, Mike Maloney, the Federal Reserve, Senator Lummis from Wyoming, keep on going on, Judy Shelton, if they do, starting from a much higher peak or plateau, from a much higher base, would be beneficial to them. And when you see banks saying, okay, now it's 4, now it's 5, now it's 6, they keep on raising their targets, which is interesting. And I don't know. I think, honestly, that this system needs to go back to some form of truth, some form of credibility, some form of trust, because what we have right now is really failing on all of those accounts, not to mention fiscal irresponsibility. We talk about, August being a huge month for tariffs, like $85 billion, yet the deficit for the month was $350 billion. So our spending is out of control. Our reputation is maybe irrevocably damaged. And the biggest money in the world is showing you, whether it be the central banks around the globe or now the institutional traders here in the United States, or whoever the hell it is bringing in billions a week in gold and silver into COMEX, that these metals are far more important than the currency that is being used and conjured up to purchase it. And honest to God, in my soul, I feel like this is just the beginning. I guess we'll see.
Capital allocation has become one of the most pressing challenges in today's distorted financial environment. Short-term treasuries may offer some yield, but when actual inflation exceeds reported figures, the real return becomes negative. Longer-dated bonds face their own structural risks, as global demand erodes and synthetic mechanisms, such as new government programs, are used to create artificial buyers. Equities trade near all-time highs, yet insider selling and waning fundamentals suggest fragility. Real estate prices remain stretched, while banks are over-leveraged and vulnerable under existing bail-in frameworks. For those seeking to preserve wealth across generations, these dynamics leave very few safe options. Precious metals continue to stand apart. They provide liquidity, no counterparty risk, and consistent purchasing power preservation. Measured against gold, the costs of real estate, energy, food, and education all appear increasingly affordable, underscoring how metals protect against monetary debasement. A simple historical comparison illustrates this. In 1978, a summer's wages at minimum wage could buy several ounces of gold, worth tens of thousands today, far outpacing tuition and inflation. With silver outpacing many speculative assets and premiums beginning to rise again, the setup suggests a potential inflection point. One catalyst could shift sentiment overnight, transforming an under-owned market into one constrained by scarcity. Let's get back to the interview.
where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year Treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month Treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a Treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. The big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly, so much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. Treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor or bail-in laws. So, yeah, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren, and how do I pass it on appropriately? Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this. And, it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything. Gold maintains its purchasing power, and most other items across the board, from food to energy to real estate, measured in gold, it's becoming cheaper and cheaper and cheaper as things measured in dollars are becoming more and more and more and more expensive. You can pick anything you want, automobiles, college tuition, and I have an answer for it. And that's the scary thing. I wrote one thing down to kind of show that. It just kind of caught my attention. And it's just very simple. In 1978, a student working full-time summer job at the minimum wage of $2.65 an hour could earn roughly $1,378, which was more than enough to cover the average tuition and fees of $688 at a public university. So when you talk about inflation outpacing standard of living, it's extraordinary. But if you look at gold at its value since 1978, when it would have been priced at I don't know. I don't know what it was back then, a few $100s anyway. But point of it is that, look at where gold is today from where it was then. In fact, let's just look real quick just to make the point. We'll see where gold was in 1978. What was average gold price in 78? Was $193.4. So if you are earning minimum wage and you're able to make, what did they say, 1,378. So 1,378 divided by 193.4. Well, you would have bought 7 ounces of gold with your minimum wage summer job that today would be worth $26,000. So that would cover your tuition in most public schools. A lot of the highfalutin ones are going to be 3 times that, because college is probably a poor example showing how much it's outpaced itself. But point of it is that, what is $1,100 worth in fiat versus in this term. I just think it's important to understand that gold and silver have done a wonderful job in the face of a dollar that is destined to continue to lose purchasing power and probably accelerate, because that's the whole premise of what they're trying to do, not only of what Trump wants to do, but Stephen Murin, who's now on the Fed and the architect of the Mar-a-Lago Accord, which speaks of a weaker dollar to stimulate and bring back manufacturing. So saving in dollars are destined to go broke, period. We're in an environment where everything seems to have accelerated. The just life has accelerated. Craziness has accelerated. And I think this is going to continue. I think that we are at that point on the curve where things are going to start to not only get crazy, but get magnified. And when you realize that all of this move that we've had, where silver has outpaced Bitcoin, silver and gold are roaring and no one knows about it. You get the public involved, and the biggest issue people will have, which has been a non-issue for over a year now, a year and a half, that's all I've talked about, is how crazy the availability is and premiums being so low. You're starting to see premiums creep. You're starting to see more people, bigger money start to come in. All it will take is one event, and this market, which has been characterized by over-availability and low premiums like that, will change. And you've seen it with your own eyes over the last 5-6 years that we've been working together closely. Granted, that was somewhat related to the pandemic, but I would say look at Silicon Valley Bank as a better example, where Miles Franklin added 14,000 clients in 45 days, where we were working, yourself included, till 10, 11, 12 o'clock at night and just had to stop in order to eat dinner and rest for a little bit. As crazy as that sounds, it's true. And why are we not hearing these massive deliveries that are just literally record-breaking, it seemingly every month? No one's talking about it. That in and of itself, another contrarian indicator. And these are the people who spend billions of dollars. They do not do these things just for the hell of it. My guess is they understand where we are going, whether they have the roadmap to it or have been, cued into the roadmap. I think you do what the biggest money in the world is doing. Stop listening to the Jim Cramers.
Ultimately, what stands out most is the disparity between perception and reality. Policymakers continue to signal control, yet the underlying cracks are widening across currencies, debt markets, and even traditional safe havens, reshaping wealth distribution in a way few are prepared for. That's why staying ahead of the curve matters. Recognizing patterns early, positioning capital wisely, and maintaining flexibility are what separate those who endure from those who thrive. Do not wait for headlines to confirm what the data already reveals. The opportunities ahead are substantial for those willing to think beyond the noise and act with conviction. If you found value in this analysis, make sure to like this video, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps us bring deeper insights to a broader audience, and it ensures you stay updated as these dynamics continue to evolve. Stay informed, stay prepared, and we'll see you in the following discussion.